Most people think the stock market is a scoreboard for the economy. So when your bills rise and your job feels shaky, a rising market feels insulting. It can feel like the system is cheering while real life is bleeding. But that reaction is built on a category error, not a hidden conspiracy. Because the stock market is not measuring your present, it is pricing a bet on a future. Here is the question this video answers, with no stock tips and no predictions. What is the stock market actually measuring if it is not the economy? Start with what you feel, because that is the honest reference point. The economy, as people experience it, is wages, rent, prices, and stability. It is whether work is easy to find and whether tomorrow feels predictable. That is the economy you live inside, and it matters. But the stock market is not designed to represent that lived experience. It is designed to price something else. The market is a pricing machine for future corporate cash, not today's reality, and not society's well-being. That sounds abstract, so let us make it concrete. A stock is a claim on a stream of future money a company might produce. Not money today, but money over many years. A stock price is what people are willing to pay now for that future stream. So the price moves when the future stream changes, and it moves when the value of time changes. This is the first mental model shift. The market is forward-looking by construction. The economy you feel is present tense by necessity. Now we get to the part most people miss. Even if a company's future stays the same, the price can still change. Because prices are not only about the future, they are also about the discount. Think of discounting as the price of waiting. Money later is worth less than money now, because time has a cost. That cost is shaped by interest rates and by risk. When that cost falls, future money looks more valuable today. When that cost rises, future money looks less valuable today. This is why markets can rise in a year that feels terrible. If investors believe the terrible part is temporary, they price past it. If the discount falls, they price even further past it. The market is not saying today is great, it is saying the future might be less bad than we feared. Now reverse it, because this is where people get whiplash. Markets can fall in a year that feels strong. If investors believe the strong year is peaking, they price the slowdown. If the discount rises, they reprice the same future more harshly. Again, the market is not a mood ring. It is a calculator that updates on new expectations and new discounting. So far we have one big reframe. The market prices a future stream discounted by time and risk. That alone explains a lot of the disconnect. But it does not explain the full anger people feel. Because people are not just comparing time horizons, they are comparing two different objects. Here is the second reframe. The economy is broad, messy, and human. The market is narrower, cleaner, and corporate. The economy includes households, government, and small businesses. It includes sectors that are not listed and work that is not captured by tickers. The stock market is mostly about public companies and their profit streams. That means the market can be right about corporate profits and still feel wrong about ordinary life. Now add one more layer that quietly amplifies the confusion. The index you see in headlines is not an even vote of all companies, it is a weighted scoreboard. Most major indexes are built so the biggest companies count the most. When a handful of firms become enormous, they dominate the headline number. So the index can rise even if many companies are flat or falling. And the index can fall even if many companies are stable. The headline number is not lying. It is just speaking loudly for whoever has the most weight. This is why people can look at the same chart and argue forever. One person is thinking society. Another person is thinking a weighted basket of large corporate cash flows. They are both using the same word, economy, but they are pointing at different things. Now we can answer the classic mystery without hand-waving. Why can the economy weaken while markets rise? Because markets can be pricing a recovery before it is visible. Because the discount can change faster than jobs and wages do. Because the largest companies can thrive even when the median household struggles. And because a weighted index can be pulled by the few. And we can answer the mirror image too. Why can the economy feel okay while markets fall? Because the market may be pricing a future slowdown. Because higher rates can compress valuations without any immediate collapse. Because risk can reprice suddenly, even if the present still looks fine. Because the market moves on surprises, not on what everyone already knows. Now we zoom out. Because how money works is never just what. It is always, why does the system behave this way? At the system level, markets move on three forces. Expectations about future profits, the discount rate, which reflects time and interest rates, and the risk premium, which reflects fear and uncertainty. These three forces can move quickly, faster than wages can adjust, faster than hiring can change, faster than rent contracts reset. So even when the market is accurate in its own language, it can feel detached. Because your life is measured in months and paychecks, markets can reprice in minutes. Here is a pattern interrupt worth holding on to. Markets are not a report card. Markets are a negotiation. Every price is a compromise between buyers and sellers. It is a live argument about the future, expressed in one number. And that argument is influenced by incentives, constraints, and flows. Flows matter more than most people want to admit. Large pools of money cannot simply opt out of markets. Pensions, insurers, and funds have mandates and timelines. When rates change, they rebalance. When risk changes, they rebalance. And that rebalancing moves prices, even without a new story. This is not manipulation, it is plumbing. And plumbing creates second-order effects, because even if the market is not the economy, it can still shape it. Markets influence the cost of raising money. They influence how confident executives feel about expanding or cutting back. They influence credit conditions, and credit conditions shape real decisions. So the market is not the economy, but it can tighten or loosen the environment the economy operates within. That is the real relationship. Not identity, but influence. Now we land the takeaway, and this is the money-explained identity lock. If you want to read markets without getting emotionally hijacked, change the question. Do not ask, is the market telling the truth about the economy? Ask, what future is the market pricing, and what discount is it using? Because the market can be optimistic about corporate cash flows, while households are pessimistic about their next 12 months. Both can be true at the same time. They are different layers of the system. This also explains why headlines can be so persuasive. Anyone can point at a rising index and claim success. Anyone can point at a falling index and claim failure. But an index is not a morality play. It is a pricing machine doing what it was built to do. Here is the quiet punchline. When you say the market is up, you are often describing a weighted outcome. And when you say the economy is down, you are often describing a lived outcome. If you do not separate those two, you can be guided by the wrong scoreboard. And that leads directly into the next foundation layer. Because millions of people now own the market through index funds. Those funds do not just reflect the market. They channel money through the index design itself. So the next question is not, are ETFs good or bad? The deeper question is what problem ETFs were invented to solve, and what new behaviors they created once they solved it. Because once you see the market as plumbing and incentives, not as vibes and justice, the charts stop feeling like an insult. They start feeling like a signal, not a signal about your present. A signal about what money believes comes next, and what it costs to wait.